Hello, welcome all. So we are starting the unit 3 in this session. So in the unit 3 we are going to learn technical analysis, Dow theory, breadth of market analysis and the stock analysis, right? So we are starting with the technical analysis. So in the technical analysis we are going to discuss introduction, definition, its history, then the difference between technical and fundamental analysis, then advantages of technical analysis, challenges to technical analysis, and Dow theory. Technical analysis, there are type of charts, different type of charts are available. Then there is technical indicators are available to do the stock analysis and the resistance and reports. Okay, so let's discuss one by one. So first, introduction of the technical analysis. Two major type of analysis for predicting the performance of a company stock. One is a fundamental and other one is a technical. So in this session we are going to talk on the technical only. So technical looks for peaks, bottoms, trends, patterns and other factors affecting stocks price movement and makes a buy and sell decision based on the those factors. So bottoms mean the bottom finishing of the stocks. So we have three trends in the market: uptrend, downtrend, and sideways. We have 40 plus patterns in the market like head and shoulder, butterfly, ascending triangle, descending triangle. And there are many other factors affecting the stock price movement. So indicators also the part of the technical analysis. So the world of technical analysis is huge. Hundreds of different patterns and indicators investors claim to be successful. Okay, so if one want to start trading in the stock market, she or she should learn the technical analysis first before starting bare hand trading, or else you will lose your hard-earned capital. So what is technical analysis? A method of evaluating securities by analyzing statistics generated by market activity, past prices, and value. Do not attempt to measure intrinsic value. Instead, look for pattern and indicators on charts to determine future performance. What is technical analysis? Technicians believe that securities move in very predictable trends and patterns. Trends continue until something happens to change the trend. Until that change takes place, price levels are predictable. So basically, the technical analysis is done on the marketing activity, then past prices and value. Most agree that technical analysis is a much more effective when combined with the fundamental analysis. History of the technical analysis is perhaps the oldest form of security analysis. It is believed that the first technical analysis occurred in the 17th century Japan, where analysts used to chart to plot price changes in rice. So one guy is there, the Chinese guy is there who has developed the candlestick patterns, which is useful in the technical analysis. So that is very deep subject. We have around 20 plus different candlestick patterns. Some of names are like bullish, bearish, then gravitone doji, dragonfly doji, Tuesday top, Tuesday bottom, Marubozu bullish, Marubozu bearish. So indeed, many present-day Japanese analysts still rely on technical analysis to forecast prices in their stock exchange, which is the second largest in the world. In the United States, technical analysis has been used for more than 100 years. Technical analysis versus fundamental analysis. Technical analysis involves the development of trading rules based on the past price and volume data for individual stocks and the overall stock market. Fundamental analysis involves economic, industry, and the company analysis that led to valuation estimates for companies, which can then be compared to the market prices to aid in investment decisions. So basically, stock analysis involves in the development of trading rule based on the past price, volume data, market movement, stock movement, angel stock, overall stock market. In the fundamental analysis, the analyst focuses on the economy, focuses on the industry, focuses on the company's details, company analysis, on its plans, visions, on its profit and loss statements. There are many more things have been added in the fundamental analysis. So, well, the analyst who don't want to do the fundamental analysis, well, actually, the fundamental analysis is usually used for the long-term investment. But those who want to start trading on daily basis, just want to trade from the 9:15 to 3:30. So our Indian market is opened around 9, and actually the trading is happening from the 9:15 to 3:30. So those who want to start the trading, they should focus on the technical analysis. Okay. So advantages of technical analysis, unlike fundamental analysis, technical analysis is not heavily dependent on financial accounting statements. As I told you, the fundamental in the fundamental analysis, the account statement has been added. Actually, the whoever has to done the analysis, they have to go through the financial accounting of the particular company, particular stock. Problem with accounting statements: lack information needed by security analyst. Many psychological and other non contributable factors do not show up in the financial statements. Fundamental analysts must process new information and quickly determine a new intrinsic value, but technical analyst merely has to recognize a movement to a new equilibrium. Technicians trade when a move to a new equilibrium is underway, but a fundamental analyst finds undervalued securities that may not adjust to current prices as quickly. Challenges to basic assumptions. Empirical tests of efficient market hypothesis, that is the EMH, shows that price do not move in a trend. One of the biggest and basic challenges to basic assumptions. The empirical tests of efficient market hypothesis shows that prices do not move in a trends. Challenges to the technical trading rules. Rules that work in the past may not be repeated. First. Second, patterns may become self-fulfilling for purposes. We have a market patterns which, as per the market patterns, price moves and it's becomes self-fulfilling. A successful rule will gain followers and become less successful. Fourth, the rule all requires subjective judgment. Dow theory. So Dow theory, under the Dow theory, uh, the average discounts everything. Market has three movements, means market has a three trends. First is a uptrend, second one is a downtrend, third one is a sideways trend. Price action determines trend. The price action is usually used in the Dow theory in the live market. Lines indicate movement. The lines mean the trend lines which is marked upon the chart with the price movement, which indicates the future movement. With the trend lines, one can predict the next or future movement of the particular stock. Price value relationship provides background. So when the lines indicate movement, let's say the movement, the price is crossing the trend line from the bottom, and at the same time its volume is also more than the average value of the previous day, then it will work as a super, like price value relation provides background and it help you to get more profit. Averages must come from. So averages means moving averages. In the stock, in the technical analysis, we have a different kind of moving averages. Like if you added 50 days moving average, it will show you last 50 days average price on the chart. And with that chart, with that average price, the stock will move up and down. It will work as a resistance and support. Well, in the next session, we will be discussing the resistance supports. Okay. So next, this is the Dow theory. On the y-axis is the price and the x-axis is the days. So you can see here how the price is going up by forming T1 and B1, T2 and B2, then T3 right? So this is the bull market view. Actually, why bull market view? It is uptrend actually. So this is the revival of the market confidence phase one. Then is good corporate earning and the speculation price. So this is the peak actually. So basically, basically, if you want to understand in Dow theory, let me tell you in the simple way, as I know about the Dow theory. So you can see this movement from here. It's just going up. Later it formed a low. Again it went up, right? So if your previous high is here and previous low is here, and then next you are getting the high. So this is called as a higher high, and this is called as a low. So below we have another low. So this B2 will be called as a higher low. So we have a higher high higher low series here, and that means this is the bull market view. That means it is in uptrend. So this is how Dow theory is working. So by in the Dow theory, the actually the two things has been explained. One is the trend definition has been explained there, the primary trend and the secondary trend. So this blue line is a primary trend, and this correction you can see that from higher high to higher low is a corrective, is a correction. It is a secondary move, secondary trend, right? So at the trend line you can see the lines. The price uptrend is just taking the support on the rising trend line. This is a flat trend line, and this is the falling trend line. So this is just going down. This is uptrend. This is sideways. That means flat market. This is the falling market. Okay. So don't miss to watch next session. In the session, I'm going to cover technical analysis part of the stock market. Thank you. Best wishes.